DiamondRock Hospitality, we're a hotel REIT. Currently, we own 37 hotels in the United States, comprising about 10,000 hotel rooms. Our strategy is to provide our shareholders with superior long-term total returns in the hotel real estate sector. We maximize our return on investment through a focus on driving the highest free cash flow yield. What does that mean? Well, we achieve superior cash flow growth through a combination of maintaining things like a conservative balance sheet, a judicious focus on capital expenditures to ensure that we're maximizing the return on that precious capital. We have a portfolio of hotels that is unencumbered by long-term management contracts, and nearly half of our hotels are independent of a brand. And fourth is a unique focus on destination resorts. It's a segment where we believe that there are really strong long-term secular drivers that should allow us to outperform. Sure. DiamondRock was born out of Marriott International, in fact, and our chairman brought this company public in 2005. This year is our 20th anniversary. Early on, the portfolio was heavily focused on full-service hotels that were managed exclusively by Marriott International. You fast forward to today, and now we have 37 hotels, as I mentioned. Just 2 of our 37 hotels are actually managed by a brand. The other 35 are managed by independent managers, and that's an opportunity for us to always be choosing those parties that we think are the best counterparties for maximizing return. That lack of encumbrance, if you will, on the portfolio is a significant value creator, and it's something that's unique to DiamondRock, as nearly almost all of our peers are exclusively brand managed. As far as the REIT structure goes, it certainly brings tax efficiencies to the ownership of real estate and provides a cost of capital advantage, vis-a-vis a privately held company that's trying to pursue real estate investments. I think being public as a REIT also, it provides access to debt capital that can be very attractive vis-a-vis some of our privately held peers. The bull thesis for our sector, I think, is simple. I mean, a couple of points is that in the last few years, inflation has driven the cost of construction well ahead of the underlying performance of hotels, which simply means that new development no longer pencils, and we're probably in a 5-year period of negligible growth in competitive supply. As an owner of real estate, that's great. You don't want to have incremental supply in your markets. I would say that's especially true for the resorts and leisure segment, where we have a unique concentration and where there has been very little construction there probably for the last 10 to 20 years. At the same time, we are seeing a preference among consumers for experiences over things. And we're also undergoing a demographic shift where baby boomers, Gen Xers are aging and spending what is effectively their peak earnings more and more on travel than just about any other prior generation. I think those are the same generational trends that what drove the success of the apartment industry 25 years ago, single family 10 years ago, and it's now knocking on the front door of hotels, particularly resorts. I think the other benefit is that there's somewhat of a post-COVID potential for the return of business transient demand and group demand that is not fully recovered yet, and I think we're continuing to see signs of that. So in addition to that strength that we're seeing in leisure that I think is more secularly driven, I think the business component, which tends to be a little more cyclical, still is yet to recover. So that's kind of my take on what the bull case is going forward. Actually, I guess I would say one more point, if I could interject, is interest rates. I think right now the outlook is that over the next 3 to 5 years, interest rates should decline. And that is a multiplier of benefits for real estate in general, and particularly interest expense. The bear's thesis, in my view, is simply that hotel REITs as a sector have historically had a poor track record of relative performance. And the concern is that does not change going forward. I'm a big believer that is going to change, partially for the reasons that I outlined in the bull thesis. And that's why DiamondRock is trying to own the hotels that appeal to the guests of tomorrow and not necessarily the guests of yesterday. Beyond that, what we at DiamondRock are focused on, and really what matters most to driving shareholder value, we are focused on driving earnings per share. I would say REITs broadly have often been accused of trying to collect, brochure cover assets in the hopes that it will drive value by increasing their multiple. I would say that today what the public market investors really want out of equity REITs is earnings per share growth. the more earnings we generate, the more we retain to recycle into new investments, to recycle into high ROI capital investment projects, as well as our dividend growth. To us, that flywheel of focusing on earnings per share growth to drive retained capital has not been turning as fast as it should have been in the hotel sector. And it's one of the reasons I'm in the seat I'm in today, is really to refocus DiamondRock on how to restart that engine. And that's something that we're attacking and been really focused on this year, is recycling low yielding capital intensive assets into investments that can produce higher long-term growth and higher initial yield. I think what sets us apart is that we are distinctly positioned with a unique concentration in destination resorts. I've mentioned that and a few times, and I think those resorts, particularly in high barrier to entry markets. Sorry, can I restart that? Let me start right again. What sets us apart? I think our portfolio is distinctly positioned because of its unique concentration in destination resorts, particularly those in high barrier to entry markets, ahead of what is expected to be an extended period of secular growth for experiential travel. I would also say that our concentration in independent and unencumbered hotels means our portfolio is more desirable to real estate and private equity investors because of the added control and flexibility that our portfolio provides versus one that is encumbered under long-term management contracts. Most of our peers have portfolios that are exclusively long-term managed by brands. Our balance sheet is very conservative, and that means we're focused on growth. We have capital to continue to grow, whereas many of our peers are still shrugging off the challenges from the pandemic, both public and private. I would lastly say is, two things. Our dividend is conservative, with significant room for growth in the years ahead. We just recently announced that our quarterly dividend would be 8 cents a share in 2025. That's up from 3 cents a share per quarter in 2024. That's significant growth, and I think there's still significant room to go ahead of that. And lastly, I'll say management. We're one of the most efficient platforms from a cost perspective. Nevertheless, our team has continued to outperform through the pandemic because we're really relentlessly focused on winning. I would describe us as a scrappy bunch, and we really are singularly focused on maximizing value for our shareholders to the best of our ability.